Traders Corner is proudly brought to you by IG, the specialists in CFD trading.
Welcome back. You're watching Traders Corner, and as always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, often we take a bigger picture look at the top 40, and I know that's where you want to start the show off this evening by having a look at that chart and where we're at.
Yes, this kind of tees us up nicely for what we're going to discuss on the show this evening, which is an option structure on the top 40. So let's quickly have a look at the big picture, looking at this top 40 index and see where it stands and how that'll then tie in afterwards to our option structure that we're doing. So there's the graph of the top 40 up on the screen at the moment. We've looked at this graph each week for the last couple of weeks, and it's gradually been building on the story that we've been talking about. And the main theme here has been that we've said to watch out for this overhead resistance at 47,200. And you can see how the market bumped up against that area in July last year, and it then had a big correction, and we've since been bumping up against it during February and March of this year, and finally it broke out to the top side. And we said all along that this was likely to happen and that we were likely to see the market probably pushing through that resistance and to go up and make new all-time highs. That's exactly what has happened now. And we've had a very powerful rally, if you think about it, from the middle of March until, well, all the way through to the end of April, really. The market's rallied about 3,500 points, if not even a bit more than that, in the space of a month. So it's been a pretty strong market. But what that's also done is it's left us in pretty overbought territory as things stand at the moment. And if you look at those momentum indicators on the top, the one right at the top here, that's the relative strength index, or the RSI. And what that's done, it's actually broken above a level of 70 and broken underneath 70 again. And that typically is considered an RSI sell signal. Okay. And then if you look at your stochastic oscillator, which is the one below it, that also is right at the top of its range, and it's also very, very overbought, and it's begun to turn down. So the thinking here is that, yes, it's a strong market. We've been making new all-time highs, but the thing is that it's not unexpected to think that we're going to have a bit of a consolidation here and a little bit of a pullback. And it's quite possible, maybe, that we could gradually pull back towards that 47,200 area where we broke out in early April.
So that would become the support, whereas previously it was resistance.
Yeah, that's exactly right. Typically what happens in situations like this, where you've got what was previously a resistance area, like it was here, where the market bumps up against it and it can't break through, eventually when it does finally power through that resistance, then what will typically happen is that on a pullback, that area would then become quite strong support. And it's fairly common to think that once a market makes a move like this, it does some sort of backing and filling, and it comes back to test that level, to test the support again.
Yeah.
So I think where we're at now, it wouldn't be unreasonable to expect that sort of trading action. And I've constructed an options structure this week to look to take advantage of any pullback towards that 47,000 area.
Now, I suppose what may be confusing to people is that you already have an option structure looking to take advantage of that very drop in the market that could potentially be coming. So why add on to that? Why take another option structure against that?
Yes, that's right. It's a good question. We do have another option structure which also runs out to June, and the one that we're doing today also goes to June. The one that we've already got actually operates from 46,500 and downwards. So in other words, below this line that I put on the graph there, that's where that other option structure, which we already have open, would start to come into play. And that would work if we saw the market pulling back really significantly. I'm now not as sure that we're going to get a pullback of that magnitude anymore. So I've looked to put another structure on at higher levels now. And look, if we did have a really deep correction, well, then we're very well positioned for that, because we'll have two option structures which both give us really nice downside participation.
Yeah.
But really the purpose for today's option structure is actually to try and get into some protection which starts and it works from a higher level. So let's quickly have a look at how this option structure has been created and what I've done to effect the protection that we've got here. This chart over here is effectively what you've got along the bottom axis are the levels of the top 40 index. And then on the left axis here, you've got the profit above the line and loss below the line, right? Now, let's go through step by step. There's three legs to this structure, and we'll talk to each one individually. So the first leg that I've done here is I've gone long of a put option on the top 40 with a strike of 49,000. I've done one contract.
Okay.
So one contract with a strike of 49,000, that effectively is giving me exposure to 490,000 rands worth market capitalization based on this, because every point represents 10 rands worth of movement. I've paid a premium for that put option. I've paid 10,306 rand for that protection, and you can see how the payoff works. Above 49,000, I've paid away the 10,000 rand, and then it starts to make money, and it actually breaks even below 48,000. Then it continues to make a profit, and it'll continue to make a profit all the way down to zero.
Yeah.
The thing is that the market won't go to zero, so we've got to say to ourselves, well, realistically, where do we think it could go? And let's sell away some of that downside participation. So what I've done against that then is I've gone short of a put option, an out the money put option, out the money meaning that this option structure would only start to become effective much lower down in the market. The strike level here is 47,000. I've sold short one put option with a 47,000 strike, and for that I've received a premium of 3,723 rand, and you can see that illustrated by this blue line on the graph here. Above 47,000 we've actually received that premium. You can see it reflected as a profit, i.e. it's above the zero line. Yeah. And then below 47,000 that option would start to lose money. But keeping in mind, of course, that by that stage our other put option, the 49,000 put, would already be making good money for us.
Okay.
Okay. So net though, you can see that I'm actually still paying around about 6,500 rand for the two options together. What I've done against that then is I've gone short of an out the money call option.
Okay.
And right now, so it does get more complicated, but what I've done is I've sold short one contract of a 50,500 call option. 50,500 is quite a lot higher than where the market is currently. It's around about 2,000 points above where the market is at the moment. And because I've sold that option short, I've also been paid for that. I've received premium. I've received 5,187 rand for that call option that I've sold short. And you can see it illustrated there. That orange line shows the profit or the premium received, and only above 50,500 then that would start to lose money. And if that were to happen, then there's a risk I'd have to protect that with buying some futures, but that's not a problem for right now.
Yeah, because essentially what you've done there is to bet that the market will not go above 50,500.
Correct.
And the person who has bought the put option, the call option off you, has bet the other way.
Bet the other way, correct.
Okay.
That's it, yeah, exactly. And the other person, as you refer to, it's a bank. It's in this case, I actually used Nedbank Capital to structure this. They took the other side of the trade on my behalf here. Okay. Because these are traded through SAFEX, and you'd used a SAFEX market maker for that.
Okay.
All right, so the net premium that I've received on the short sale of the put and the short sale of the call option, the net premium received therefore is 8,910 rand. So if you take the difference between the premium paid, 10,306, and the premium received, 8,910, it leaves you with 1,396 rand. That's what I've paid away. So I've paid 1,396 rand. It's not a lot of money.
No.
And it gives us quite nice downside participation. Now, if we were to actually overlay all of these and simplify it, and I mean, I know it looks like a game of pick up sticks right now, but let's tidy it up a little bit. That yellow line that I've just introduced onto the graph there is the overall payoff of how this structure works.
Okay.
Let's tidy it up even further. That's what it looks like now. So to summarize it, effectively between 49,000 and 50,500, I've paid away a premium of 1,396 rand. That's gone. Above 50,500, I'll then start to lose money.
Yeah.
I can deal with that if we get there.
Okay.
I can hedge that. Below 49,000, the structure starts to make money, and it makes its maximum profit at 47,000, and the profit is then capped. I can't make any more money. If the market falls below 47,000, I don't make more. The maximum I can make here is 18,604 rand.
Okay.
And that's if the market were to fall to below 47,000 on the June futures closeout, which is the 18th of June in this case.
But if it does fall below that, you've still got the other option structure which will then kick in.
Exactly. So below 46,500 is where our other option structure would then start to work. Then that one starts to make money.
Okay.
So we're actually in a situation where, if this market were to pull back 10 or 15% from these levels, we would really be in a strong position.
Yeah.
I'm not sure that it's going to pull back that much between now and June, but you never know. This is the time of the year when markets do typically get a bit bumpy.
Yeah. So Garth, if you overlay that, which you normally do, okay.
Yeah. All right. So first of all, you can just see, I mean, the green illustrates the profitable area there. The red over here is our danger zone, and that's where we would start to lose money on the structure. But I can make a plan to hedge that out if needs be, if and when the market gets to that level. So if I overlay it on a graph of the top 40 now and go back to that original chart of the top 40 index that we looked at, let's have a look and see how does this all stack up now. So there's the chart we showed earlier, looking at the graph of the top 40 index. Here is our option structure now overlaid on that graph. So you can see the salient levels that we've mentioned. There's 49,000, there's 50,500 up there, and then down here is 47,000. So the point being that anything below 49,000 is where we start to make money on our option structure. And if the market were to pull back towards this area of 47,200, round about 47,000, that sort of zone, you can see that we'd be perfectly placed with this structure to take advantage of it. And I could then go long against it because I know that I've got the protection in place.
Okay, so I remember the last time you went long against an option structure was last year, and the markets fell on its head, and that was what gave you sleepless nights.
Yes.
Presumably, it's the opposite. What would give you sleepless nights now is if the market were to soar ahead. I mean, would you still be able to hedge yourself against having hedged yourself against losses?
Yeah, I would be able to. If the market goes above 50,500 over there, then I would need to probably look to buy one contract of a June futures contract.
Okay.
And I can see I've got time to assess and see whether that's necessary, whether it becomes necessary. At this stage, that call option, that short call option, is far out the money.
Yeah.
So I don't need to worry about it at this stage. But yes, if the market was to rally and go crazy upwards, then we do carry some risk at that stage.
Because it's not just the premium, isn't it, that you've paid. It's the risk of the market turning in an extreme fashion against you.
Yes, exactly. It's if the market went very, very aggressively higher, we'd need to make a plan to hedge that risk.
Okay.
But as I see it, I think the risk of that happening is quite low, and I think the higher probability outcome here is that this market will probably retrace and come back and maybe test that 47,000 area where we broke out in April.
Yeah, Garth, it's almost slightly more complicated than usual because there was a call option and put option. So obviously people can rewatch the show, and presumably on your website you'll have laid out the mechanics of the trade.
Yes, I've put this up on the traderscorner.co.za website already, and this video will also be available on the website and also on the Business Day TV website as well.
Okay, so anything further to add then about the construction of this?
Not on this. I mean, the only next step for us really is to have a look at our portfolio and see how it stacks up as things stand at the moment. So right now we've effectively only really got 2 open trades, and they're both option structures, and they're both looking for downside participation in the market. So, you could accuse me of being bearish, I suppose, but I'm not really bearish.
Heaven forfend.
But I'm not really bearish, but I mean, I think realistically it's not unreasonable to expect a little bit of a retracement and a bit of a consolidation from this area. And if that does then happen, we've got very, very nice protection in place to take advantage of that. And of course, that would then also put us in a strong position to then buy the market against any pullback that we see.
And the fact that your premiums this time round were somewhat lower, was that just a function of the fact, the way it's constructed? Because it does tend to jump around a bit, the premiums that you end up having to pay on structures like this.
Yeah, it often depends on the levels and the time when I'm able to put a structure on. In this case, when I did this structure last week, the level of the June futures contract was 49,215. So it was pretty high. So that meant that we, from a timing perspective, I did well because it meant that this option structure was very close to self-funding. If you went to go and try and replicate this now, you'd probably pay quite a lot more in premium because the market has already pulled back about 500 points odd from when I did the trade.
Okay, so that's so there's always an element of luck in the game.
Sure.
So Garth, the portfolio is up 26.94%. It's down a little bit fractionally from last week.
Yes, because I've accounted for the premium, the 1,396 Rand we've paid away. So last week we were above 318,000. We've come a little bit lower this week, and that's because of the option premium.
And just very quickly to end off with your upcoming courses.
Yes, I've got 2 courses in Johannesburg which I'm going to be running in June. Understanding CFD's course on the 4th of June and a high probability trading course on the 6th of June. So anybody that's interested in attending one of these courses, please email me, Garth@traderscorner.co.za, and I'll send you all the details.
Okay, great. Garth, we'll leave it there. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner. Stephen and Alicia.
Traders Corner is proudly brought to you by IG, the specialists in CFD trading.